Let's try and find out the strategy that one can adopt at this price point, as well as what are the sectors that one can look at right now. With this, let me welcome George Thomas, who is the fund manager equity at Quantum AMC. Hi, George. Thank you so much for your time. Firstly, wanted to understand that how do you see the market set up given the kind of so much of good policy announcements on the China front? How do you see the fund flows moving into India, as well as for the next 6 months, what sort of a return expectation one can have on the index level?
Hi, thanks for having me in the show. So when we look at the current valuations across the broader markets, so generally, if you look across sectors, most of the sectors are trading near full valuation. So there is very little room in terms of upside from current levels. This is true for most sectors, barring financials and certain select names in specific sectors where the recent past has not been very exciting. So coming to the China policy announcement, so if you look at the past few decades, that was a period when China has been aggressively building its infrastructure, and therefore in that kind of an environment, those are fairly large. Let's say, uh, if you look at those consumption patterns, those metals and things, those would be consumed on a fairly large scale in that kind of a development phase. But our sense is that peak infrastructure development is behind us. So if I were to take a next 5-year view, our sense is, even though they have announced fairly good stimulus measures, uh, if we see, those may not result in kind of consumption for metal or any other commodity to that extent what we saw in the past decade. And if you look at the post-COVID period, that was a synchronized stimulus across the globe. So even globally, the other parts of the world was growing fairly good, and again that coincided with a period where the inventory levels were fairly weak across globe. That may not be the case in the next 4 or 5 years, but it is a possibility that that sliding trend on commodity prices could be arrested with the recent announcements. But we don't feel like this could be a case where you would see massive spikes in commodity prices. But coming to the flows, with where the valuations lie in China at this point, there could be some possibility that some of the FII flows could be diverted to China. But having said that, Indian markets, with the DII money which has been flowing quite reasonably well, the markets might get some support from those DII flows.
All right, that's the take on the markets. But George also wanted to understand that since we are just going to hit the results season and believe that you have been bullish on the IT space. So this time, though we have seen the kind of earnings and the guidance that Accenture has given, and even Indian IT companies were trying to find some cues from that. But from the earnings perspective, how do you expect IT earnings to pan out, and which could be the great performers in this particular quarter, believing that the market participation has been a lot more in the mid as well as the small end of this particular sector, while the large caps were lagging behind a little. So Thomas, what's your sense on the IT space overall, and which part of the whole sector can perform very well?
See, IT, our sense is you cannot have a very prolonged period of low tech spending, because that kind of gets back to how the business performs, because IT systems have become fairly important from an overall perspective. So after many quarters of muted growth, our sense is IT spends has to pick up, and that has been the trend what we have observed even historically. But if Gen AI and things were to pick up, probably the hardware spenders could see fairly rapid growth in the initial phase, and that would follow on with the IT service players for those integration demand and things. So incrementally, our sense is things should improve from here on. And if you look at the order books for most of the IT players, so they have been fairly robust. So our sense is, the clients have been waiting for how the macro environment shapes up to push the pedal on those discretionary spends. And our sense is, with the rate cuts and all have starting, this could be a time where we could see some acceleration in IT spend. So we are fairly positive from a growth perspective from the current levels. So incrementally, things should look better from where we are today. So coming to the positioning, we are more positioned towards the large cap names, which would benefit in large end-to-end integration deals. Some of the mid and small cap names, they've been factoring too much of positive news, and valuations are slightly expected, slightly on an expensive side compared to what could pan out on the earnings front.
All right, more position on the large cap IT names, and thank you for your take on the overall sector, but also help us with your take on the financials as well. Thomas, do you find valuation comfort in this particular sector, believing that though the index is very near to its all-time high levels, I'm talking about the Nifty Bank Index, but in that as well, very selective counters are hitting those all-time high levels for themselves. So do you believe that there's a valuation gap and one can benefit out of it?
See, last few years, the major problem which has been haunting this banking sector, the financial, is one, the liquidity was not abundant, and therefore, credit growth, there was a wider gap between credit growth and deposit growth. And number two, the credit cost across the board was benign. So that when a credit environment is quite benign, what typically happens is you may not end up differentiating a bad lender versus a good one. Our sense is, both these cases would normalize going forward. So the credit environment continues to be benign, but there could be some bit of normalization which we could see in the next few quarters. If you look at the current profile, some pockets like MFIs or credit cards are seeing some bit of stress coming up. So when in that kind of an environment, we would see the larger private sector banks who has a better underwriting skill to stand out. And number two, as the liquidity in the system gradually improves, we would see that the gap between credit growth and deposit growth kind of narrowing, and that would benefit them in terms of the incremental margins and stuff. So it may not be as tough in a falling interest rate environment. It may not be very tough for the banks to raise deposits. They may not have to raise deposit rates from here on to accumulate more deposits.
All right, Josh, thank you so much for taking the time out and speaking with us and helping with your take on the overall market setup, your take on the IT as well as the financial space. Pleasure having you. Thank you so much for that.
Thank you.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.